Hello, my name is Robert Kiyosaki. I'm the author of the book Rich Dad, Poor Dad, and also the creator of the board game CashFlow. So I want to thank you for your interest in the board game CashFlow as well as this new electronic version of it. When I am asked why did I create this board game, I created it simply because I wanted to be able to find a way of teaching people the same important financial literacy and financial intelligence lessons my rich dad taught me. I had to find a way of compressing it, making it short, making it fun, to compress basically 30 years of education into one game board. So I'd like to explain why it was created and also the two main lessons you can learn from this game. Lesson number one is you'll learn how to be an investor. Today, all of us need to learn how to invest, especially with these flaky 401k and these risky mutual funds and the stock market going up and down. We all need to learn how to become investors. On the board game CashFlow, you will learn what very few people learn. You will learn about the 4 different levels of investor. Level number 1 is a small deal. And that's where most people should start at. As a little boy, I started investing in small real estate and small stock deals. Level 2 is the big deal. As you get more money and become more sophisticated as an investor in real life and on this board game, you do go to level 2, which is big deals. The third level is the level that the rich invest in. This is called the fast track. The 1933 Securities Exchange Act defined that only the people who are rich were allowed to invest on the fast track. You had to be a millionaire. And the fourth level is CashFlow 202, which uses the same game board to play that game. CashFlow 202 is what the sophisticated investors use. It's called technical trading, how to use insurance when you invest, how to make money when the market goes up and the market goes down. So those are the 4 basic lessons about investing you will learn by playing this game. 4 lessons that most people never even know exist. 4 levels of investing that most people have never heard about. So by playing this game, you will learn how to be an investor, you'll be introduced to the really complete world, the complete whole world of investing. That's one of the most important things you'll learn from this game. The second thing you will learn is you will learn how to use an income statement and balance sheet. In other words, you will learn to understand what accountants know. This here's income statement, this is the balance sheet. My rich dad said if you want to be successful in the world of business and investing, you had to be financially literate. And financial literacy begins with this here. My rich dad also said that his banker has never once asked him for his report card. His banker never asked him if he had good grades or what school he went to. He says in the real world, once you leave school, what your banker asks you for is your financial statement. So the 2 important lessons you will learn from this game are, 1 is about the 4 levels of investing, and 2, the levels of accounting. Given all the problems we've had in the stock market lately, you'll realize that many of the analysts were giving bad financial advice because the analysts could not read a financial statement. They could not see the big companies actually lying and cheating the investing public. So that's why I created the board game CashFlow. 2 main lessons. 1, the 4 levels of investing, and 2, the importance of financial literacy. CashFlow is the only game that teaches you both lessons in one game. That's the power of the game. It's what my rich dad taught me, and that's why I'm excited about you taking a look at this game for yourselves. I'd like to talk to you about the degree of difficulty ingrained in CashFlow 202. Some of you know I began designing the CashFlow board game around 1994, and initially the whole board game was 101 and 202 combined. And the problem was when people got together to play that game, 101 and 202, unless you were a very sophisticated investor who understand fundamentals as well as technicals, you couldn't play the game. So we broke the games apart, leaving 101 as purely fundamental, and then 202 is fundamental plus technical. The reason we made it this way is because it is more real life. As we all know, markets go up and markets come down. Anybody tells you that they're hoping the market goes up, they're actually a dreamer or a gambler or a speculator. And I hope markets go up, but I'm not counting on it. Market can go up, market come down. I make money either way. And so that's what professional investors are looking for. On top of that, professional investors actually like it when the markets crash because things are at bargain prices, you can go in very easily. It is the amateur who thinks only in market trends going up that get wiped out. So 202 is a lot more difficult because not only do you have to pay attention to the fundamentals, cash flow, capital gains, now you have options, the market's going up trending, you have markets coming down trending, but you also have shorts in there and all this. 202 is more like real life. 202, if you're not that bright, you can get wiped out in a split second. And you get everything taken away from you, as many people have, especially lately in the Asian crisis and the Russian crisis and things like this, or even the New York Stock Exchange and NASDAQ crash between 2000 and 2003. So the power of the power of CashFlow 202, it is a combination of fundamental and technical. It includes accounting, it gives you options, insurance, it's higher risk, which means that you have to be smarter. This is not just a game. This is the game for real. This is the way the real markets of the world are played, and what you're getting in are the fundamental and technical skills so that you can be a much better professional investor in the real world. So play this game a lot. The more you play this game, the smarter you get. Teach it to more people, and the more people you're challenged, the smarter you'll get. You'll never be afraid again of markets going up or markets coming down, because you won't care, because you'll make money going up as well as coming down. So welcome to CashFlow 202, the electronic version. Also welcome to improving the journey to your financial freedom here. And one way to get to your financial freedom is to increase your vocabulary or your use of financial terms as well as financial tools and vehicles. For those of you moving up the ladder or becoming more sophisticated, a very important word or part of your financial education is how you use options. I absolutely love options. So many people think, you have to invest for the long term, you buy, you hold, you diversify, you save money. That's kind of a very expensive way to do business. The more sophisticated you become, the more knowledgeable you become, the more you'll want to use options. Now, many people think options are primarily in the stock market. That is not correct. We use options in real estate also. A down payment is often an option. So you go up to a person, you say, I'm going to put $10,000 down, and you now have the option to purchase this property, and if you find bank financing, all of this. But in options are used everywhere. Same as in insurance. Every time you make that monthly payment on your life insurance policy, that's an option. So the insurance company is betting you're going to live a long time, and you're kind of betting that you're going to live a short time. So that's also an option. But the option that we'll be covering more importantly in 202 are the options in the stock market. And this here is one of the fastest, most volatile, most exciting, most fun, but also the most dangerous investment game you can play. So that's why I'm glad you're here for CashFlow 202, because really what it is about options used in the stock market, puts and calls, basically that. And if you can learn how to use puts and calls, you won't care if the stock market goes up or the stock market comes down, because it won't make any difference to you. You can make money going up and you can make money coming down. And that's one of the power of options. You're not afraid of losing as much money as most average investors who are investing for the long term, buy, hold, diversifying their accounts are so afraid of losing. If you understand options are like insurance. That means you won't lose the whole thing. If you lose, you'll just lose a little bit. So options are a very important tool, a very important part of your education, and a very important thing to use on your way to financial freedom. Options are very important, so welcome to CashFlow 202. Okay, going back to the idea of professional investors don't care if markets go up and markets come down. We're going to go into that, but I want to reiterate one more time. When I talk to people and I say the market's going to crash, and they go, oh, I don't care if it's stocks or real estate or whatever. You know they're not a professional investor, because a professional investor doesn't care. They'll make money going up and they'll make money coming down. So to be professional, you need to have 2 different strategies, at minimum, possibly 3 strategies, depending upon the markets, as to how you handle the trends in the marketplace. So let me give you an example. Let's say the market's going up, which most people like. The amateurs love it, the professionals like it, and all this. At this point, you may just buy the shares of stock. Or you could buy an option, like a call option, as a market trends up. Most people love these types of markets. But as we had, up until the year 2000, this went up and up and up, and then suddenly it couldn't go any higher. And all markets come down. There's always booms and always busts. So that's why professional investors know you need to have at least two strategies. So when the market started to get toppy or choppy right around the year 2000, the professionals shifted their strategies. Instead of buying, some of them went into what's called a short position. So meanwhile, while the amateurs were buying, holding, and praying, taking laps around the bead, saying, oh, please keep the market up, the professionals went short. And what a short means is this. Let's say the stock is at $50 here, to make it simple. What they'll do is they'll go to their broker and they'll actually say, sell me 1,000 shares at $50. Now, this is the trick. They're selling 1,000 shares of stock they don't own. Another parlance is naked. They're selling something they don't own. So so they sell 1,000 shares at $50. The broker deposits in this person's account $50,000. These shares are borrowed from another person who's just holding the money holding the stocks in their account. And let's say this professional investor is right for that day, and the stock plummets on down like a horse falling out of a window. And then the reason they say that you can make more money in a down market is because it takes a long time for the bull to come up the market, but the bear goes out the window, comes down really, really fast. So meanwhile, the people that are hoping and praying the market goes up, they're caught. The bear goes out the window and starts to come down. And let's say this stock now hits $25. It's down. What this means here is this person who went short goes back in and buys 1,000 shares at $25. So they put up $25,000 of their money, and then they replace those shares into this person's account who they borrowed the money from. So what they make is $25,000 profit minus some fees because they went short. So this is one way. It's like a nothing down real estate deal. It's called making money without money. The price actually came down. They buy the shares back when it's cheaper. They replace the 1,000 shares into the person's account, and they keep the difference between the buying price or the price they borrowed at and the price they bought at, and make $25,000. So this is an example of a short of the stock market. Again, this is very risky because if the price had gone up, they might have lost everything. So this is a 202 or more an advanced type of investor type of strategy. Nonetheless, it is used commonly in the stock market. But all this shows that a person can make money when the market goes up, and they can make even more money faster when the market comes down. But to do that requires you investing more and more time into your financial education and your experience. So moving further along into the subject of stock options, we're going into the two basic types of options used in the stock market, puts and calls. And again, I'm going to reiterate something. Whenever I say to an amateur investor the market might crash, and they get all upset, they want to argue with me and all this, I know they're an amateur at that point because they don't understand puts and calls or options. And because a professional investor doesn't care if it goes up and doesn't care if it comes down, because they'll protect their position either way. Another word for options is the word insurance. In the stock market, this is also called a hedge. It means a little protection. You want to put a barrier around your value of your stock. So let me give you an example. Again, this is very simple, extremely simple, oversimplified in fact. But the subject of puts and calls as far as options goes is one of the more complex, and sometimes it takes massive amounts of brain power that I don't have to explain it. But let's keep it very simple for the start right here. So let's just say you buy a stock at $10, and over time the stock goes up, and let's say it's $50, and now you're afraid the market's starting to look like it can't go any higher. At this point, a professional investor say, I don't want to lose my $50 position. At this point, a professional investor may buy what's called a put option. The key word is that they will buy this option. Now, what a put option allows you to do is this is insurance. In case the stock does, as they suspect, come plummeting down back to $10, they don't lose everything they've gained in this area. So what a put option in this case would allow you to do, if he purchased it, would allow the buyer to sell stocks at $50. So a put option allows you to sell a stock at $50. So even though the stock today is at $10, the put option is your insurance saying somebody has to pay you $50 for insurance. So that's why options are so important, and especially in the stock market, because you don't want to ever invest without insurance. You don't drive a car without insurance. You don't own a house without insurance. And many people invest without insurance. That's ridiculous. It's also called being naked. It means you're out there exposed. Moving along to call options, let's say the stock chugs along and you say, I think the stock's going to go back up again. Certain things are happening in the company. People are getting excited about it. You don't want to miss the move up. At this point, a person may buy again, keyword is buy, a call option. So what happens is, let's say you're right, and the call option may cost you $1 or $2, put maybe the same price, so not very expensive. And let's say the price suddenly goes up back again to $50 again. What a call option allows you to do, or a put allows you to sell, a call allows you to buy the share at $10, even though the stock is at $50 that day. So this is a very simple way of how professional investors either buy or sell in their use of options, puts, or calls. This is extremely simple. It took me a while to get my head around it, so please take your time in understanding it. If you need to rewind and look at this again, please do so, because it's very important to understand how professional investors use puts and calls. Once again, in this situation, by buying a put, if the stock fell down to 10, the put allows me at this point to sell my share at still $50, even though the price is at 10. And in this case, if the stock market moved up to 50, the call option will allow me to buy shares of this stock at $10, even today the price is at 50. So options are a very important way that professional investors invest, and these are the two basic ways: puts and calls and options. Thank you. We're now going to be talking about one of my favorite subjects and one of the reasons I love real estate, and that's called a real estate 1031 exchange. Let me give you an example of how it can contrast to the stock market. Let's say I buy a stock at $10 and it goes up to $20. So I have a $10 capital gain from 10 to 20. Today I'd have to pay either approximately 35% for short-term gains, or 15% on the short-term gain. In other words, my capital gains is taxed. With real estate, one of the beauties of it is this is 1031. It's not a tax-free, but it's a tax-deferred exchange. So let me explain how this works. Let's say I buy a piece of property for $100,000. And a couple of years later, it goes up to, let's say, $300,000. So suddenly I sell it, and I have a $200,000 capital gains here. And if this was traditional capital gains, I would pay today in America, I'd pay 15% of that to the government, which is not bad. If I had done this in less than a year, it might be 35% taxable rate of $200,000. But the beauty of real estate is I can put this money with what's called a qualified, and we used to call them exchange agents. They don't really call that. It goes into this fund, and it's handled by a person who's a specialist in the 1031. The money, this $200,000 capital gains where this whole transaction goes in here, and then I can pull outside of here the $200,000, and I can buy, let's say, another piece of property, let's say $1 million property, using that $200,000 down payment without paying any of the taxes upon my gains over here. So very simply, what a 1031 allows me to do is I can defer my taxes without having to pay them, which means I can get more of my money over time. Eventually, technically, you're supposed to pay the taxes on it, but most people don't. They just keep pushing it forward until they don't need the money anymore. So one of the powers of real estate is in America called the 1031 exchange. This here is somebody who specializes in it. You can go in the phone book or ask a real estate broker about these people, and they will help you acquire more property without having to pay that much in taxes. And so that's one of the advantages of real estate over paper assets such as stocks, bonds, and mutual funds. You can actually sell but not have to pay the taxes immediately. We're now going into one of my more favorite or subjects, also one of the hottest and sometimes the most controversial subject when it comes down to the world of investing. Most people, when they invest for capital gains. And you can hear that in their vocabulary when they say, oh, I bought a stock and I think it's going to go up. I bought it for 10, I think it'll go to 20. They're holding for capital gains. People do that too with real estate. They say, I bought a house for $100,000 and I expect it to go to $200,000. Again, that's capital gains. Or somebody says, my net worth has gone up because my house has appreciated in value. Again, that's capital gains. And there's nothing right or wrong with it, but as a professional investors are investing for cash flow, not capital gains. Capital gains, if you're holding a stock or a piece of property or a business for capital gains, that's really speculation, also another word for gambling. You're hoping something will happen in the future. For myself, I'm always holding for cash flow. I generally do not buy something unless it puts money in my pocket every month. And I mean cash, not earnings, not all of that stuff. I want cash flow. So it becomes a very important subject, and the more you look into the world of investing, you'll find out why the richest investors invest for cash flow while the amateurs invest for capital gains. Nonetheless, there are times when I do invest for capital gains, and including I do that sometimes in real estate alone. And sometimes I do that in real estate myself. One way of doing it is what I was taught by my rich dad was that the formula for great wealth is found on the board game Monopoly. And we all know the formula. The formula is 4 greenhouses, 1031 into a red hotel. 4 greenhouses, red hotel. So a lot of times we get into the market buying small things that we're going to flip for quick cash for the capital gains, but eventually you want to transfer it into cash flow. Because cash flow, that steady cash flow, is what really gives you the freedom. Many times this doesn't give you freedom, it gives you worries, because if stock goes up, price goes down, real estate goes up, down, down. What I want is this in the long term over here. In the stock market, they often shift people into bonds for income and things like this. But as you know, bonds today are paying, 7% and down. It's not very high cash flow. So it's very important to understand the power of capital gains. So a lot of times, what I'll do is if the trend, again, the trend is important. Let's say that the real estate trend is this way. That means people are moving into town at a high rate of speed. That means housing prices have to go up because more and more people are coming in. If people are moving out, the price will go down or go this way as per se. But a lot of times what I'll do, and in this game CashFlow 202, you'll have what's called starter homes. And a starter home is a great place to begin your investment portfolio strategy in the real estate market. You look for starter homes that are low price, low down payment. The FHA likes to lend people on starter homes or duplexes or fourplexes and make it very easy. You get 90% financing on those things. It's a good way to take advantage of a rapidly moving uptrend, which we've had in real estate for the last 10 years going this way. So that's what you do is you buy it, you sell it for capital gains, you buy it, you sell it for capital gains. Hopefully you put it into a 1031, but you don't always have to do that. But what you're looking for is enough capital or cash so you can eventually buy the red hotel that gives you the cash flow. The beautiful thing for me as a young boy starting at age 9, I saw my rich dad start with small starter homes, and in less than 10 years he owned the big red hotel right on Waikiki Beach. So I actually saw my rich dad playing this game called Monopoly in real life. When I was 9 years old, he had little greenhouses, and by the time I was 19, he owned one of the larger hotel blocks on Waikiki Beach. And that hotel today is gone, but his family still owns the land under that big hotel. It took them 10 years. And so that's the power of starting small, making your mistakes early, and you will make mistakes. Don't be afraid of that, but don't take huge financial risks. Don't shoot for the moon or swing for the backfield right away, the ballpark right away. Start small, get some experience. Hopefully the market continues its trend, and eventually you'll shift your investments over into a larger deal for cash flow. Previously, we covered options when it came to the stock market, and generally, people use puts and calls there. But options are also used in real estate quite extensively. And from my point of view, one of the most famous ways people use options is a down payment. So let's say I'm going to buy a house for, let's say, $100,000, and I go and I put $10,000 down. Some people call this a down payment, but what this $10,000 means to, and then the bank gives me $90,000. I'm going to use the banker's money to get rich. The reason I look at this as an option more than anything else is because if the price goes to $120,000, I now have the option to sell it for a higher price. The risk is if it goes down, then I can't get in trouble, as that's true with any kind of option. So that's one of the ways that options are used in real estate. And again, for me, from my perspective on it, a real estate down payment is an option to either buy this property later on or refinance it. And the beauty of real estate is this: if the price of this property goes up, the bank still only gets $90,000. Let's say it goes to $150,000, you get the $50,000, but the bank still gets the $90,000. That's why I absolutely love real estate, and I love the idea of options in it. Another way an option can be used is you can go up to a seller or somebody has a house and say, look, in 3 years, I want to buy your house for $10,000 or something like, $10,000 more than you owe right now, and here's my paper, but just give me the first right to buy it. And you generally have to give them something like $1,000 for that right for that option. That's another way it's used. Another way options are used in real estate, which I use quite often, is let's say I go up to a project and they say, we're going to break ground in 1 year on this apartment or condominium project, and you can buy a condominium right now before it's even built. So it's called a pre-construction purchase. It's also called buying off the plans. In other words, and I don't recommend this wholeheartedly, but off the plans means the building's not even built yet. But you go up to the developer because they have to sell so many of these projects. They have to sell so many units or get so many buyers committed to them. So let's say I give them $1,000 down. The price is $50,000 today. And 3 years from now, when the project is completed, the project's worth $150,000. At that point, I don't have to buy the project. I don't have to finance this $150,000. What I can do is just basically sell my position, my option, to somebody else for the $100,000, and they can buy the property also. So I do all these types of options in real estate, and even right now I'm buying 6 units off the plans. The buildings aren't even built yet, but I'm putting an option down, and in 3 years, hopefully, and this is called speculation, not investing, because I'm speculating the price will go up. The option just assures me there's a certain price today, and I'm betting that the price will be higher in the future. So these are the types of ways options are used in real estate also. Thank you.
Before getting into the details of the board game CashFlow, I'd like to explain some of the bit larger features of it. You may notice that there's 2 tracks here. The reason there's 2 tracks is my rich dad said in real life there are 2 tracks. For example, when my poor dad said to me, go to school so I can get a job, work hard, buy a house, save money, my poor dad was basically sentencing me or saying to get into what's called the rat race of life. And this is where I would say 94% of the population spends their life. When you say to a child, what do you want to be when you grow up? Or what do you want to go to school and get good grades and get a job? That's where most people wind up in the rat race. They get up, go to work, get up, go to work, get up, and go to work, round and around and around. And given the state of the economy and the different types of investment plans today, most people, not most, but many people will never ever get out of this rat race. They'll get in here and die here. So my poor dad said his advice was basically go into the rat race. My rich dad said, go into the fast track. So this is where the rich invest, this is how the rich operate from. So what is found on the rat race here are things like paychecks. You get downsized, as you know, we have very little control over job security today. There's also charity and things like this. The object of the game is to be able to get out of the rat race and onto the fast track. And the way you get onto the fast track is proving you're a good investor and you have a high financial IQ, which requires the financial statement. And that's why the game was created in this way with 2 tracks. This is the track of my poor dad. This is the track of my rich dad.
I'd like to take a moment to discuss in detail something very important for those of you serious about becoming rich, becoming financially free, and that is the importance of a person called your auditor, oftentimes called a bookkeeper, or your accountant, or your CPA. My rich dad said this: if you're going to become rich, become a professional investor or in business, you must have a bookkeeper, accountant, or an auditor. The reason for that is they check your work. They keep you honest. They keep your records neat, timely, and accurate. You may ask any banker. Ask them if a person shows up and the banker says, show me your financial statements, and if you don't have any, or they're not timely or they're not kept, your banker will automatically know that you are not serious about becoming rich, and they will automatically discount your credibility at that time. They may hand you a simple one-page financial statement, but by not having accurate records for 3 years or more, accurate, timely, neat records for 3 years or more, your banker knows you're not serious. So that's why my rich dad said your auditor is a very important person to have on your team. Your auditor checks your records. So the beauty of this electronic game, the computer is your auditor, but it's also there to remind you in the real world, have an auditor, have a bookkeeper, have an accountant, keep accurate records. If you're serious about becoming rich, your auditor is a very important part of that team, and that's what it's there for. That's what we remind you of that importance. I'd like to discuss the importance of charity. Charity was very important to my rich dad. My poor dad always said, I'll give money when I have money. And what my rich dad said, the reason your dad doesn't have money is because he doesn't give. In other words, my rich dad believed in the law of reciprocity. You can call it, Newton's law, give and you shall receive, or for every action is equal and opposite reaction. Or the Asians say karma, give what you want. So my rich dad explained to me, if you wanted a smile, the best way to get a smile is to first give one. He also said if you wanted a punch in the mouth, the best way is to give one first also. So he said if you want money, give money. Today I hear many people saying, well, I don't give money, I give my time. The problem with that thinking is you get back what you give. If you give time, you get back time. So charity is very important if you want to get rich and get on to the fast track. You need to give what you want. And if you want money, you need to give money. You need to first give, and then you can receive. That's why charity was so important to my rich dad. Charity was a very important part of my rich dad's financial and business plans. Early on in my life, I had to make a decision not to follow my poor dad's footsteps and do what he did, which was get a safe, secure job, even though it was high paying with the government. Instead, I decided to follow my rich dad's footsteps and go into the B quadrant. Now, most of us know the failure rate is fairly high in the B quadrant. I think the stats say 9 out of 10 businesses fail in the first 5 years. And that was true for me. So I recommend this. You may want to keep your daytime job and start a part-time business like a network marketing company. The entry point financially is very low, less than $500. Or you can buy a franchise, and a franchise will give you the system to be a business owner. Or you can do what I did and just do it trial and error. If you do it trial and error, I recommend this. Give yourself at least 5 years in the B quadrant, because it takes some time to learn the mental, emotional, and technical skills to be a successful business owner. I meet many people who say, well, what if I fail? I'll just tell you my point of view. In the B quadrant, since the chances are you're going to fail 9 out of 10 times, I just made a decision that I was going to start 10 different companies. So it really does get with a context or a mindset or an attitude at which you take this on. I have failed many times, and many businesses fail in the B quadrant, but I've always learned something new. And today, for me, the B quadrant is the only place I would like to be in. I now want to go into a subject that's near and dear to many people's hearts, and that's the subject of debt or borrowing money from the bank. I hear many people say, cut up your credit cards and get out of debt. And I would say for probably 90% of the population, that's very good advice, simply because most people, since we're not taught much about money or accounting or investing at school, that's good advice. But if you're going to become rich, you must know the difference between good debt and bad debt, or how to use your banker's money or other people's money to become rich. So a successful, financially successful person knows how to use debt to get rich, where most people use debt to get poor. When you look down at a financial statement, it's very simple to see here. There's assets and liabilities. What most people are doing is they're borrowing money either for expenses or they're borrowing money for liabilities. That's bad debt. If you want to become rich, you need to borrow money to buy assets. Assets are, in other words, you're borrowing money or going into debt to get rich. Most people are trying to pay off debt, which is a good move, like I said, because they borrowed money for expenses and for liabilities. In this board game, you will find the interest rate is 120%. Now, most people say, well, that's too high, or that's usury, and it is. But the reason we made the interest rate so high in this board game cash flow is to demonstrate to you that if you know how to invest, you can borrow money at a high interest rate and still make money. That is the lesson of this game, and that's how you use debt. There's good debt and bad debt. The choice is up to you which one you use. The higher your financial intelligence, the more good debt you can use, and get out of this rat race and get on with your dream. Probably the most exciting aspect of the rat race, and the reason so many people stay in the rat race all their lives, is this card here, doodads. Doodads are the things that make life worth living. For instance, having a nice car, nice clothes, nice watch, jewelry, going out to dinner, new stereo equipment. The problem with doodads is doodads keep most people broke. And this is why they buy doodads thinking they're assets, as it goes back to the financial statement here. In traditional accounting, you're allowed to count a doodad as an asset when it's really a liability. For example, let's say I buy a boat. Your banker will allow you to list your boat as an asset when it really is a liability. The reason people do that is because they've not been trained financially to actually read a financial statement. And many people think their house is an asset when it's really a liability. You know, when your banker says to you your house is an asset, your banker's not really lying to you. He's just not saying whose asset it is. Your house is really your bank's asset. So that's why the doodad card is so important. The way my rich dad taught me to enjoy the good things of life, because I don't believe in living frugally, I don't believe in living below my means, I don't believe in saving money. I believe first in buying assets, and then my assets will buy my doodads. That's how the rich do it. The middle class, unfortunately, and the poor, they buy doodads first and never have any money left over to buy assets. For example, a number of years ago, I wanted a new Porsche. I had $50,000 in cash on the savings line here. Instead of buying the Porsche with the cash, I went out and bought a piece of real estate. That piece of real estate then gave me the cash flow via which I could buy my Porsche. So today I have my Porsche, which is still a liability because I have upkeep on it, like insurance and repairs and tires and gasoline. But I also still have my piece of real estate, and in many ways I still have my $50,000. So the way you can buy all the doodads you want, all the wonderful toys of life, all you have to do is first buy assets first, doodads second. That's the way you get rich and enjoy the good life. I personally do not believe in living below my means, being frugal, or denying me the wonderful things that life offers me. If you want a boat, have your boat, but buy an asset first, boat second. And that's the secret to getting rich and having all the doodads you want, so you can keep up with the Joneses and pass them with cash flow. I want to talk about another word, again, vocabulary, a new word that sort of crept into our society in the last 20 years. That word is downsizing. So question is, when you look at the cash flow quadrant, the employee, self-employed, or small business, business owner, investor, who does the word downsizing affect the most? And in this case, it's the employee, because the reason employees are afraid of the word downsizing is the truth of the matter is, today there is no job security. And I go back to my poor dad always saying to me, go get a safe, secure job. Well, that was a good idea in his time, but not my time. So all of a sudden, all these people who did as they were told, they went to school, had good scholastic grades or good professional grades, they're a lot afraid now because they're not in control. So downsizing affects these people. One of the beauties of the cash flow game is even though you're downsizing, you'll soon find on the game that even if you're downsized, you're not out of the game because you're still investing. So the purpose of the cash flow game is to train you with the business skills to become business owners and investors. So keep playing this game. Even if you're downsized, you'll find out that even as an investor, you're still in the game. So downsizing only affects employees who really have no control because their boss is in control, and it affects people with 401ks, again, because they have no control over their mutual funds. So the purpose of this game is to have you not be afraid of that new word called downsizing. So let's start the game. The first step is to choose your dream. People say, well, why is choosing your dream the first step? Because it's the reason you want to play this game. You see, I know so many people who don't go for their dreams simply because they say, oh, I don't have the money, or they think they can't afford it, or they don't have the education. One of the reasons for playing this game over and over and over again is, number one, to open up your mind and then give you new ways of thinking, the fundamental basic education so that you can invest wisely regardless of how much money you have, and then have the money to buy your dreams. And so dreams are very, very important. In other words, why live life if you don't have your dreams? So the very first step is choose your dream. That's a very important first step because that's where you always start with the end in mind. You always start with your dream and work backwards. That's what your first step is. Choose your dream. Another aspect of playing this game here is you may land on what's called the market card. When you go to the market card, you'll actually draw this. The significance of the market is that you're paying attention to the trends. It's like reading the newspapers, watching the television, and all this. The market is basically telling you market's going up or market's going down, who's buying what and who's this. The market card on this board game is very important because if you're going to be a professional investor, you must pay attention to the market. And that's why the market card is here. I want to take a moment to discuss mutual funds. Mutual funds are the most popular of all investment vehicles in history. I'm often asked, why don't I recommend them? And I'd like to explain that right now. Mutual funds are designed primarily for people who have this type of education. As I said earlier, there's three basic types of education which are required for financial success in the real world. That's academic, professional, and financial. Our school system has very little financial or investor education. So my poor dad was the man who always said, this is very important education. My rich dad said this was important education. So to answer the question on mutual funds, this is the way it goes. If you have only this type of education, academic and professional, then mutual funds are perfect for you. That's who they were designed for. If you want to invest in other investment vehicles, then in most cases it will require more financial education. And it's not financial education you can learn in a classroom. It is financial education that is mental, technically, emotional, as well as physical. You have to do something. So mutual funds are great for these people, but I personally would not invest in them or bet my financial future or my retirement on a mutual fund. And the reason for that is this. As we have all found out just recently, but most of us known for years, or professional investor needs to know, any market has three basic trends: an uptrend, downtrend, and a sideways trend. This is called a bull, this is called a bear, this is called a channel market. Mutual funds in most cases do well in a bull market, and they take a hammering in a bear market. So that's why I don't like them. The mutual funds I know lost so rapidly in the crash after March of 2000. The problem with mutual funds, they give you no personal control over your financial future. If the market goes up, you do well. Market comes down, you lose in the channeling market. So that's why I don't like mutual funds. They give you no control. If you want control over your financial destiny, then you have to have financial education. And that's where richdad.com comes in. It gives you the financial education to take control of your financial destiny. In the cash flow game, I purposely put in some of the real estate deals negative cash flow. What that means is basically you're losing money or your tenant is not paying enough money to cover all your expenses. Now, in the real world, I personally do not recommend people starting off with negative cash flow deals. Yet, as you improve your investment skills, there are times when a negative cash flow deal may make sense. And it may make sense if the property values in the areas are appreciating right here. So that what you're going to get from it is the property will appreciate. You might lose a few dollars a month, but the appreciation is far greater than the few dollars you lose a month. Let's say you lose $100 a month, but the property is appreciating by $10,000 a year. In that case, and only in that case, would I recommend negative gearing. So as you're playing the game, watch out for negative cash flow deals, because they might just be a great deal if there's a lot of appreciation. I'm often asked, why do I recommend network marketing, especially since I'm not in the network marketing business? And like many people, early on, I had a very negative or closed-minded attitude toward network marketing. But I've changed my mind. I've opened up the way that I think, and I've looked at the network marketing industry, and I find some things that are extremely beneficial, especially for people who are looking to make some changes from the E and the S over to the right side of the quadrant. One of the beauties of network marketing, it actually teaches the mental, emotional, and technical skills to be in the B quadrant. Because somebody in network marketing has the potential of building a system with over 500 people in it, plus unlimited income. The things that network marketing teaches you is the most important skill in the B quadrant is the ability to sell. One of the reasons I worked for the Xerox Corporation when I got out of the Marine Corps was to learn how to sell. My rich dad said, if you're going to be in the business quadrant and become big business, you must learn how to sell or communicate to employees, to specialists, to investors to raise capital, as well as to my customers. So communication or sales skills are essential for somebody in the B quadrant. And the network marketing industry, not all of them, but some of them have excellent training programs to teach you how to sell, how to communicate, how to build businesses. The other thing that's beautiful about the network marketing industry, it teaches you self-confidence. Because the reason many people are not good in the B quadrant is they're afraid of rejection. And network marketing teaches you to handle your own fears, overcome your fear of rejection, and build that self-confidence. And that's essential for the B quadrant. Also, it gives you time. In the real world, when I worked for Xerox as an employee for 4 years, if I didn't sell, I was fired. The beauty of network marketing industry is they'll work with you. You can take as much time as you like to develop those skills. As your skills increase, so does your income. Take 1 year, 2 years, 5 years. It takes time to develop those skills. And the network marketing industry gives the education and the time to build that self-confidence. Once you have your business up, the reason the cash flow game is so important, and you have all this excess money coming from your business, then you can invest your money into real estate and stocks and bonds, and that's what the cash flow game teaches you how to do, is how to be a successful and proficient investor, especially an investor on the fast track. The fast track is where the rich invest. So the beauty of network marketing works really hand in hand. It builds you up, teaches you how to increase your income, builds your self-confidence, and then the cash flow game teaches you how to invest. And that's why I recommend network marketing, and that's why I work hand in hand with so many of those businesses. So let's get into some of the more details of actually playing the game. For example, you get on the rat race, you roll around, and you land on opportunity cards. When you land on the opportunity card, you have basically two choices. One is a small deal and one is a big deal. Small deals are investments of $5,000 and below, and big deals are $6,000 and above. The interesting thing about this game is games actually reflect people's behavior. I'll say that again because it's important. Games actually reflect people's behavior. Like, I've seen savers just save, I've seen cheaters cheat, and the game, whatever is going on with you will come up in this game. And when it comes to the small deal and big deal, oftentimes I'll see people playing this game, they have no money. And even though they have no money, they think they have to be the John Wayne of investing, and they'll take a big deal card even though they have no money. So the beauty of this game here is you get to see their behavior. Another beautiful thing, as I said, there's four levels of investing. Small deals, big deals, fast track, and then CashFlow 202. The beauty of this game is you can get rich on small deals, big deals, fast track, and 202. It makes no difference. So anyway, the funny thing about this game is I meet these, generally men, they think they have to do a big deal card even though they have no money. And that's a reflection of their behavior. I'm often asked, what should I invest in? Before I answer that question, I'd like to go back again to the basics of financial literacy or financial intelligence. This here is an income statement and balance sheet, also called a financial statement. My poor dad was a man who thought a high-paying job or a salary was everything in life. My rich dad, on the other hand, said the asset column was more important. So my rich dad trained me to become an investor in the assets. And what he taught me is there's three basic types of assets that you can invest in. The reason my wife and I could retire young and retire rich is we didn't have a job. Instead, we spent our lives developing assets over here. So these are the three assets that are available in the world of business today or investing. One is a business. Second is real estate. Third is paper. In my opinion, the reason there are so many the reason there's so few business owners is because of all the asset classes. This is the toughest one. It takes the most mental, emotional, and physical power to acquire. That's why guys like Bill Gates or Michael Dell, they built great big businesses. That's why they became so rich. Real estate is number two. In our real estate investment project, the 6 steps to becoming a successful real estate investor, there's more to real estate than just buying it. There's managing it, financing it. So all those 6 steps are important. The third class is paper. In my opinion, and people will debate this, the reason the masses of people are in paper assets is stocks, bonds, mutual funds, is because this is, of all the asset classes, this is the easiest one to get in, also the easiest one to get out of. It takes the least so-called financial training to acquire and manage. So right now, as you sit and look at this program right here, Rich Dad's Cash Flows game is designed to give you the fundamentals that you can make the choice for yourself whether you want to acquire businesses, real estate, and paper. Many people say I'm a real estate person. That's inaccurate. I have businesses, real estate, and paper. And so each one all of them require some degree of financial education, financial literacy. Of all of them, though, this is the one that requires the least. I want to pass on one more secret to how people get rich. Many people keep their daytime jobs and start a part-time business. That's what network marketing does. But you can also start a part-time franchise, or people like Henry Ford started a part-time business in his garage, which became Ford Motor Company. Michael Dell started Dell Computers in his dorm room, and other people have started their businesses on a kitchen table. So one of the ways that rich get rich is, or recommend getting rich, is keep your daytime job and start your part-time business. As I also said earlier, the tax laws are different for each of these quadrants. When you're in the B quadrant, you have the best tax advantages of the rich. So keep your daytime job, start a part-time business, gain the best tax advantages available to any of the quadrants, and then invest your money. That's how the rich get richer. So let me go into further detail about the rat race. This is where all players start. You enter here. What you'll find on the rat race are opportunities. You have a choice of small deals or big deals. There's also a paycheck period. This is how you get additional money. There's doodads. And what most people spend their lives buying are these doodads. It could be a new boat, new house, new watch, new clothes. And that's the reason most people don't get out of the rat race, is because doodads are number one in their lives. There's also charity and also market cards. The object for the game, like I said, is to prove your ability to invest, show you have a high financial IQ, and get out of the rat race and then get on to the fast track where the rich really invest. What I'm going to go into are the pros and cons of these 3 assets. As I said, in my opinion, just my opinion, to be an entrepreneur, to build a business, takes massive, probably more emotional skills and people skills. So if you're very good with people, know how to sell, know how to raise capital, know how to go to the market, talk to employees, business is the one for you. But again, for me, it took 5, 10, 20 years of training to become a business owner. Second is real estate. Real estate has many advantages. The number one advantage of all is that of all the investment categories, it's the easiest one for the banker to give you money. You know, it's tough to get a loan for business sometimes, and I've never met a banker yet who would give me a 30-year, 5% loan for a mutual fund. But in real estate, it has advantages. I use my banker's money. They're easy to finance, and the great thing about real estate, it's dumb. It doesn't move. So if you really know what you're doing with real estate, in my opinion, is the best one for the masses of people. The reason paper is such an attractive asset, again, is because it's so easy to get into. To make it for $50, you can buy one. It takes very little intelligence, very little maintenance. The problem with paper assets, you know, again, is volatility. Markets go up, markets go down, and markets go sideways. And the problem with paper assets, for most people, they have no protection from the downside protection. Paper assets generally do well when the market goes up. They lose everything coming down. So reviewing again, the reason I like real estate is, number one is my banker will give me money for it. And number two, the tax laws are most favorable for real estate owners and business owners. So those are some of the basic differences between the three different types of assets. RichDad.com is committed to giving you the basic information so that you can do well in all three assets.
So the question is, how does a person get out of the rat race and onto the fast track? And that's where this part of the game comes in, the income statement and balance sheet, also called the financial statement. As I said earlier, you learn two primary skills in this game. One are the skills to be an investor, and two, the general principles of accounting. So, very early on in my life, my rich dad said you have to know the difference between assets and liabilities. Simply put, assets are investment items such as stocks, real estate, or businesses that put money into your pocket whether you work or not. And liabilities are things that take money from your pocket whether you work or not. The reason most people don't get out of the rat race is very simply because they're buying liabilities they think are assets, like a house. Most people think their house is an asset when it really is a liability. So the way you get out of the rat race in this board game cash flow is simply learning how to invest, taking your income, investing in either stocks, real estate, or businesses, and that income flows into your income column without you working. The moment your passive income, that is income without you working, passive income is income that comes from your investments. Passive income is income coming from your assets is greater than your expenses. Once your passive income is greater than your expenses, bam, you're out of the rat race and you're onto the fast track. The moment your passive income is greater than your expenses, your financial intelligence has gone up, and that's the object of the game. Going further into the power of options, and again, I say we're only scraping the surface of this. It can be a very complex subject, yet to me it's one of the most exciting subjects as far as being a professional investor is the power of options. But another strategy I like are covered call strategies. And covered call strategies work really well when the market is kind of not going anywhere. It's kind of flat here. So for those of you who may have a portfolio of stocks, let's say you have 1,000 shares of a blue chip stock like Microsoft or IBM or something like this, but the problem is the stock price isn't going up and isn't going down. The question is, how can you use an option strategy to make you some money? So one way you can do that is, let's say you have 1,000 shares, what you can do is sell or write a covered call. So covered means you actually own the stock. Naked call would mean you don't own anything and you're still selling a call or a put on it. I don't recommend naked positions, yet some people make fortunes doing that. So let's say we're very safe. Let's say you have 1,000 shares that you own already. Let's say the price is approximately trading around $25 a share on average. It's going up and down like this. So the question is, how do you make some money at this? And one of the ways is by writing covered calls. So let's say the call cost $2, the call option. Because you have 1,000 shares, you call your broker up and you say, I want to write. Write means I'm going to sell covered calls on 1,000 shares at $2. Immediately at that moment, the stockbroker deposits in your account $2,000. In other words, $2 for the option that you sold that somebody else bought times 1,000 shares. So you made $2,000 like that. And that's one of the ways to convert a kind of a stagnant or a non-performing asset into cash flow. Now let's say it's a 30-day option, you made $2,000. Then you go another 30 days, you make another $2,000, and so on. There's a lot to learn in this. Please don't start doing this because of this short little introduction to covered calls. But this is one of the ways that professional investors use options very safely to make money, even though the stock price isn't going up and down. So I'm going to take options just one more step. I don't mean to confuse anybody, but sometimes I get confused. And just to reiterate, options are a very important aspect of anybody who wants to be a professional investor, be it stocks, bonds, insurance, or real estate or business. Options are very important. When most people think of options, they think of buying options. My first example, people buy options, but they might buy a put option as an insurance package. So the stock doesn't fall down below it. But what really professional investors do, they don't buy options. What they do is they sell options. And this is one of the more lucrative and the most powerful ways that professional investors make money in the market. So let me give you a very simple example. Again, I'll just stress, most people buy options, but the real pros sell options to people who want to buy them. Let's say the stock price has drifted on down. It was $50. It's now $10. At this point, what a person might do, especially when it's down around 10, what the professional investor might do is they might sell put options. And so they sell to this person who's afraid that the price will go down lower. So they'll say, I'll pay for your stock. I'll pay you $10 if it goes lower. So they sell the option, let's say for $2, and let's say times 100 shares, which is a contract in a options portfolio. So you charge $2 times 100 shares. That means you make $200 right there. And if the stock goes down lower, below 10, at that point, you as the person who sold the option, you have to then pay this guy $10. So you better be very careful, make sure that you don't think it's going to go much lower here. But this is cash flow. This person has made money selling something for $2. They don't have any money in the deal, but it's almost like free money if you know what you're doing. So it's highly risky, but if you know what you're doing, you can make $200 like this, selling the option, the put option, but not buying it. On the flip side of it, let's say what happens is this way, the stock goes up and it plateaus off, and let's say you bought some shares. I recommend buying them in this case. When the stock is up here like this, what you can do is also at that time sell a call option. What selling a call option means is this. So let's say you sell this times $2 also, times 100 shares, you've now made $200. What that means is, let's say the stock price at this point is $20, and you say a call option means if the price goes to $25, you would have to sell them the stock at 20. So this type of strategy, investment strategy of selling options, works good when the market is not going up, not going down, it's sort of stable. It's called a channel market over here. So you sell call options all day long, and you're making $200, you sell 1,000 shares, it's $2,000, and all this. This is highly speculative, highly risky. You should know what you're doing, but this is the way that most the real professional investors in options make their money. They don't buy options, they sell options, because most options expire without ever being exercised and all that. But again, this is part of your education. There's a lot to learn in either buying or selling options. Yet just for you to understand, but this is where the real big money is made, and this is where the professional investors make their money in options. They don't buy them, they sell them.